Howdy everybody, welcome back to Accounting 1101. We are on our final video of the internal control unit here. And we're looking at internal controls over that cash account. And probably the biggest internal control that we can talk about in that regard is our bank reconciliation. So if you've never done a bank rec before, if you've never balanced your checkbook, this is going to be for you. I'm going to walk you through what a bank reconciliation is, and I'm going to show you how to do one. And hopefully that way you'll be ready to tackle your homework problems. So here we go, bank reconciliation time. First point we need to make before we even get into how to do a bank reconciliation. Why is it necessary? It's necessary because cash is highly sought after. Everybody loves money, right? We can spend it. The other issue is cash doesn't have to be converted. If I steal money, I don't have to convert it to money. It's already money. If I steal somebody's expensive baseball card collection, I've got to convert it to money. I got to sell it. I got to fence it. If I steal somebody's car, if I steal inventory, whatever it might be, if I want money, I've got to convert all that. That takes effort. Also increases the likelihood I'm going to get caught. So you put those two factors together. The fact that money is highly sought after and easy to move around, the fact that it doesn't have to be converted, it's already ready to spend, you better protect your cash in your business with really good, strong internal controls. And as I mentioned, one of the best ways you can do that is with the bank reconciliation. So what's the bank and their role in all this? Well, obviously the bank is going to reduce the amount of cash that you have to keep on hand in your business. In businesses, we don't want to leave tons of cash sitting around. We try to make those deposits daily. That way we don't have a bunch of money sitting in our business. We count it up at the end of the day and we take it to the bank, or an armored truck comes and gets it. And we keep it in a safe until that truck gets there. So the bank helps us reduce the amount of cash that we have to keep on hand. Also instrumental in facilitating those EFT transactions, electronic funds transfer, right? We do those through our bank, and we can make electronic payments and we can collect money electronically. And then the other important role the bank plays is they provide an independent recording of cash transactions. The bank tells us all the transactions they processed on our behalf via a bank statement. Every month we get a statement for the bank, and that statement's going to show us what deposits went through the bank, what checks had cleared the bank and the bank cashed, what fees and charges the bank has hit us with, maybe any NSF checks, non-sufficient funds, where we've taken a check from a customer and put it into our account, and that check ended up not being good. The customer didn't have the money. The bank takes it back out of our account. That's an NSF check. It also will list all the EFT transactions, any interest that we've been paid, and also that ending balance per the bank. And we can see that ending balance right there on our case bank statement. So here's the deal. We get that bank statement every month. And very rarely does that ending balance right there on the bank statement ever match up with what we have in our accounting records at the end of the month. And there's going to be a difference between the two. That's where our bank reconciliation comes in. Now, bank reconciliations aren't just for that little old lady that you get behind in Kroger who likes to balance her checkbook as she's kind of checking out. You ever get behind somebody like that and you're like, come on, let's just get out of here. You can balance your checkbook at home. I'm trying to get through the line. It's not just for those people. Bank reconciliations are an absolute necessity for your business. Even if in your personal life, you just think about a bank reconciliation and balancing your checkbook, you're like, I don't need to do that. I'll just go online and look at my balance every day. Or I'll just have an alert set up. Every time I make a transaction, the bank will send me a text message. That's all well and good. But we can't rely on those alone for our business. Okay? Because normally in a business, you have a lot of transactions coming in and out. It's something that you're going to maybe need to keep a little bit better eye on, because one thing it's going to help us do is catch errors. It's going to catch errors that we've made. Believe it or not, the bank makes errors too. It's going to catch errors that the bank has made. So what is a reconciliation exactly? It sounds like a big fancy accounting thing. You hear about reconciling accounts all the time in accounting. It's not that hard of an idea. All a reconciliation is is making one number agree to another. That's it. And so when we say we reconciled the numbers, we're just meaning we made the two numbers balance out, equal each other. So a bank reconciliation is reconciling our cash balance in the accounting records to the balance on that bank statement. We're trying to reconcile those two numbers and make them agree to one another. So how do we do that? It's all a matter of making the two sides talk to one another. And when I say the two sides, I'm talking about your bank statement and your accounting records. So there will always be things that we've done in our accounting records, in our accounting on the books, that the bank doesn't know about. Maybe we made a deposit right at the very end of the month and the bank hasn't run it through yet. We call that a deposit in transit. Maybe we've written checks to people and they haven't cashed them yet. We know we wrote them. We took them out on the book side, on the accounting side, but the bank hasn't seen them to cash them yet. We call that an outstanding check. So things that we've done in our accounting records that the bank hasn't seen yet and doesn't know about, we've got to include those on the bank side of our reconciliation. Deposit in transit, we have to add to the bank side because the bank hasn't seen it. We need to add that into the balance the bank is showing. Outstanding checks, we have to subtract from the bank side. We wrote them, they're in our records as having that money going out the door, but the bank hasn't seen them to cash them yet. So we have to subtract those out of the bank side, that bank statement balance. So on that bank statement, we're going to have all the things that the bank did that we didn't know about until we got the bank statement. Things like interest income. Maybe the bank paid interest income and we didn't know the amount until we got the bank statement. Maybe they hit us with a monthly fee, a service charge, the NSF checks. The bank found out the customer that paid us, the check wasn't good, so they took it back out of our account. And maybe they collected a note payable on our behalf. They collected it and just put it into our account. So all these different items are things that the bank statement did, or the bank did and shown on the bank statement that we didn't know about. So all of these items are going to have to be included on the book or ledger side of our reconciliation. We're going to add in the interest income. We're going to subtract out the bank fees. We're going to subtract out those NSF checks. We're going to add any notes that were collected on our behalf. The wild card here is, what about an error? Sometimes we make an error. Sometimes the bank makes an error. You just kind of have to look at those scenarios and figure out what the error is and who made it and where it needs to get added to or taken away from. Okay, so we have two sides of our bank reconciliation. We have two numbers we need to reconcile. The book side to the bank statement. And these are the things that we're reconciling right here. So let's do an example and see if we can work through one together. Here's our example straight from some of your homework problems here. You can see we've got Wolfpack Bread Incorporated. We got a bank reconciliation we're trying to complete. We have a bank side and we have a book side. And I'm going to kind of draw a line here between the two. We have our bank side, we have our book side. And we're going to reconcile the two numbers. Following data were accumulated for use in reconciling the bank account as of August 20, Y9. Cash balance according to the company's records at August 31, 6,865. So that's our balance according to the books, the ledger, our company's record. We're going to put that number right here on the book side. 6,865. And what I like to do sometimes when I'm working the accounting problems is maybe take a little snip shot, and then I can check things off as I go along. So there's A, we've done A. B says cash balance according to the bank statement, 9,165. So there's our deal. The bank says we have 9,165. The accounting records say we have 6,865. We need to make those two numbers equal one another. We need to, what's the word? The fancy R word? Reconcile. And so when you're sitting at home tonight and you're having dinner with your family and they said, what'd you do in your online learning today? You can say, well, I learned how to reconcile a bank account. And they'll be really impressed with you because reconcile sounds like a big fancy accounting thing. How about C here? Checks outstanding, $2,855. Think about trying to get the two sides to talk to one another, that book side and the bank side. We wrote the check. We know those checks came out of the account because we put them on the book side and took them out. So they need to be reflected on the bank side. So what we're going to do with those is we're going to subtract those checks outstanding. And your drop down may have some different words there. It may say like less checks outstanding or minus checks outstanding, whatever the case might be. But we're taking those out, $2,855, because we need to say, hey bank, we wrote some checks that you don't know about, so those need to come out. A deposit in transit, not recorded by the bank. Again, we made that deposit on the book side, recorded it when we made the deposit. The bank hasn't seen it yet. So we're going to add that deposit in transit in on the bank side. Bank hasn't seen it, but they will. $1,075. So we're going to add that deposit in transit, and we're going to subtract out the checks outstanding, and that's going to give us an adjusted balance. That adjusted balance needs to equal the adjusted balance we come up with on the book side. So I'm going to pause for a second and do the math. You can do the math as well, and we'll make sure we get the numbers in there. All right, so I've done the math, and you can see our adjusted balance on that bank side, $7,385. I'm going to put it there just to make it a little bit bigger so we can see it. And again, the game we're playing is we are reconciling, trying to get the bank statement to equal our books. We got two more items we need to take care of reflected on the ledger or the book side here. A check for $280 issued in payment of an account to a supplier was erroneously recorded by Wolfpack Bread as $820. So we have a little dyslexic moment here. We've transposed a number. The check was for $280, but we recorded it in our books as $820. The bank cashed it correctly. The bank cashed it for $280. This is an issue where we wrote it down wrong in our accounting records. So we've got to fix it in our accounting records. Again, those errors are a wild card. You just kind of have to look and see which way we're going. So I'm going to subtract the two numbers. I'm going to take $820 and I'm going to subtract out $280. The amount of mess up here is $540. So am I going to add it or am I going to subtract it? Well, I took out too much to begin with. In my accounting records, I wrote it as $820, was really $280, so I need to add that money back. So I'm going to put that error in as an addition. Putting that money back in from where you messed up. Finally, we have a bank debit memo for a service fee. The bank likes to charge you those fees. That's how they make the big money, right? So that bank fee obviously is going to come out on the book side. Didn't know about that until we got the bank statement, so now we need to make our accounting records reflect. So we have our error that we're adding in here. We are subtracting out that bank fee. And again, I'm going to pause. I'm going to throw the numbers in there, and we'll see if the math works out. So we've done the math now. We've added in that bank error. We've added in that to the beginning cash balance according to Wolfpack Bread there. And we came up with a subtotal. We subtracted out the bank fee. And we ended up with an adjusted balance of $7,385 on the book side. So again, the idea is we're trying to make the two numbers talk. We got that bank statement. It said we had $9,165. We got our accounting records and they said we had $6,865. The reality is neither of those numbers were right. Once we do our reconciliation, we find out the actual balance in cash at the end of the month, $7,385. So I'm going to give you all a try. I'm going to pull up another example here, and you all can try to make the bank reconciliation for that one. Exact same kind of idea, but we have different numbers. Again, your goal is to try to get that adjusted balance to equal on both sides. So go ahead and pause your video, take a few minutes and try to work through that problem and see if you can get it to work out. And then when we're done, you can go ahead and unpause and we'll show you what the answers are. So there we go. Did you get it to work out okay? Were you able to get all of the numbers in there and get the two sides to balance? Our bank side and our book side? Hopefully you were able to. Other reconciliation issue, aside from just doing the bank reconciliation, we've got to do a little bit of accounting. On that book side, everything that we do on that book side of the ledger, we got to kind of make a journal entry for. And so some other things that we might have to consider that we didn't see in the problems. On the book side, maybe that non-sufficient fund check, interest income, collecting a note on our behalf, we saw them maybe on the bank statement. Those are all things that we're going to adjust for on the book side. The only other thing we'd really run into on the bank side would be a bank error. Maybe we'd have to adjust for an error the bank has made by adding or subtracting on the bank side. So those are other reconciliation issues that we have. Doing some additional accounting and also handling some additional things on the reconciliation. So just to give you some practice, identifying those reconciling items, you can see we have 10 different items here that need to be handled on a bank reconciliation, and you need to kind of pick out where they go. You have 4 options. We can add it to the cash balance on the bank side. We can subtract it from the cash balance on the bank side. We can add it to the cash balance in our books, or we can subtract it from the cash balance on our books. So go ahead and pause the video again and see if you can find the correct treatment for every one of these reconciling items. We'll pick back up with the correct answers. You can check your work against what we have. So there we go, the correct answers on identifying those reconciling items. Hopefully you were able to come up with those. If you didn't, if you missed a couple, need to go back and study. Make sure you understand what goes where on that bank reconciliation. So our final thoughts on bank reconciliations here. We need to be doing them monthly, every month, for every single cash account we have at a bank. Okay, so if we have a payroll account, if we have maybe a savings account, a checking account, whatever the case might be, we do a reconciliation for every single account. And our goal is to get the bank balance and the book balance to equal or reconcile. As I mentioned, we also have to make journal entries to record anything that shows up on the bank statement that we haven't included on the books yet. So every one of those reconciling items that we have on that ledger side, we got to make a journal entry for. We don't have to make any journal entries for the stuff on the bank side. That's a bank deal. We've already made the entries. But anything that we adjust for to the ledger side, we got to make an entry for it. So after looking at our video today, you should be able to understand the need for that monthly bank reconciliation, why it's important. You should be able to identify those reconciling items, and you should be able to complete a bank reconciliation. And believe me, you're going to get practice on that because you're going to have problems in your homework where you have to make that bank reconciliation. And if I'm looking into my crystal ball here, you're probably going to even need to be able to do it on an exam. It's that important. So if you have any questions about that, if you're working on your homework and having trouble getting that bank reconciliation to equal out, shoot me a line and we'll hopefully be able to walk you through that. Aside from that, that will wrap up our unit on internal controls, and we will continue on further through the book and through the material as we come back for next week. So hopefully we'll see you all then.